fundamental reason why gold and silver, especially gold, is rising is the robust central bank buying. So the central banks of major countries around the world, like Poland, like China, not all of them, but some of them, are buying gold. Now, it's not, up until now, it's not been a huge rush, but bear in mind that the numbers we get are very, very heavily lagged. So we're only just now seeing the figures for July or August, in some cases only up to June. So we don't actually know what they're doing this month, but I suspect that central banks are now starting to feel that they're in competition with each other to get the gold, because we all know that there are worries about holding dollars, for example, due to the weaponization of the dollar, due to the fact there's not been any action to rein in the US debt. The government debt is getting bigger and bigger. It's growing by 6% a year. It's probably going to be growing by 7% this year. We're at 37 trillion of debt in the United States, and that should grow by 2 trillion next year.
Gold and silver are entering a powerful new phase in their long-term bull market, driven not by retail speculation, but by large-scale central bank accumulation. As global debt spirals out of control, with U.S. government liabilities now over $37 trillion and growing 6 to 7% annually, major central banks are racing quietly to secure gold reserves. Nations like China and Poland are diversifying out of the dollar amid concerns over debt monetization, inflation, and the weaponization of the U.S. financial system. The result: gold surging past $4,100, silver pushing beyond $52, and volatility entering levels unseen in decades. Clive Thompson, a seasoned financial analyst and macro strategist, points out that the gold and silver markets are now in a historic squeeze, technically overbought, but fundamentally underpriced relative to the risks in fiat currency systems. As yields, deficits, and political instability converge, gold remains the ultimate bridge to whatever financial architecture comes next. For investors thinking long-term, price dips and rallies are noise. The signal is clear. Sound money is regaining global relevance. Now, we present the clips from Clive Thompson's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
As this news was breaking on Friday, in a flight to safety, driven by this uncertainty about tariffs, some investors, a few investors, not too many, bought gold and silver. Now, gold and silver market is a much smaller market than the stock market, so it doesn't take a lot of money to move the gold and silver prices. So the gold and silver prices continued the rally they've been having literally all year. They continued to rise higher. So on Friday, on Tuesday, Monday, that's yesterday, spot gold surged through $4,100 an ounce. It's the highest price ever. It was up 2.21% on the day. Now, gold doesn't usually move that much. It's there's a lot of liquidity in gold. It moves up 0.25% or down 0.25% on a good day. So a 2% move is, as gold stands, it's a huge move. So up 2.2% on the day yesterday at 4,100, and I can tell you that as we speak now, gold is continuing to surge. It's 4,100, and guess what? $45. Another 40-something dollars up. By the time you see this video, in maybe an hour or so after I've made it, could be God knows where it'll be. But bear in mind the warning which is coming. So silver was an even more amazing metal, but it's not the most amazing metal I'm going to get to yet. Silver surged above $51 and then above $52. For all I know, it might be above $53 now. We'll have a look at that in a second or two. So silver was up 3.1% on the day. Another absolutely amazing move for a precious metal which shouldn't be moving all that much. And so where is the silver price now? Let's just have a quick look at that. $52.95. So it's gone through $51, $52, and it's on the cusp of going through $53. It wouldn't surprise me by the time you switch this video on that it's above 53. We don't know. So what are the factors driving precious metals higher? I just ask you, can you think of anything which makes, why would people buy gold? Any idea?
Because I think the stock market will go up.
Maybe, yeah. Well, I can tell you a few things. We've got the US and China trade tensions going on. We've got geopolitical uncertainty everywhere. Geopolitical uncertainty is when people are worried about wars or other bad things which happen in politics. We've got the expectations of the Federal Reserve interest rate cuts. What that means is interest rates might be, well, they will be reduced, and if they're lower, then the cost of holding gold is less, because if the interest rates are high, you can put your money on deposit and earn interest. And if you're earning 5% interest, you might say, why would I buy gold? It has no yield. But if interest rates are 2%, well, I can give up 2% for the possibility of making a gain in gold. So lower interest rates are generally perceived as good for non-interest bearing assets like gold or silver, or Bitcoin for that matter. And the other, perhaps the most fundamental reason why gold and silver, especially gold, is rising, is the robust central bank buying. So the central banks of major countries around the world, like Poland, like China, not all of them, but some of them, are buying gold. Now, it's not, up until now, it's not been a huge rush, but bear in mind that the numbers we get are very, very heavily lagged. So we're only just now seeing the figures for July or August, in some cases only up to June. So we don't actually know what they're doing this month, but I suspect that central banks are now starting to feel that they're in competition with each other to get the gold, because we all know that there are worries about holding dollars, for example, due to the weaponization of the dollar, due to the fact there's not been any action to rein in the US debt. The government debt is getting bigger and bigger. It's growing by 6% a year. It's probably going to be growing by 7% this year. We're at 37 trillion of debt in the United States, and that should grow by 2 trillion next year. And the interest element, the interest that the government's paying on that debt, is getting larger and larger and faster. So just to illustrate that, a couple of years ago, the US was paying about 8% of its tax receipts in interest. Now, because interest rates on the maturing debt are higher, and also because the debt itself is higher, the interest cost is getting on for 18% of its tax receipts. And according to the Congressional Budget Office, if you crunch their numbers and look forward as to what they're projecting, in a few years it will be 22% of their interest. So we're talking about interest costs being literally a quarter of everything the government gets in taxes, and that figure probably is set to continue going higher ad infinitum unless something is done. We might go into a new system at some point. There might be a series of steps. I've got several which I see as possibilities. But whatever happens, I can say that, and people are realizing this, gold is what can get you to the other side of whatever's coming. The warning is this: the technical indicators for gold and silver are flashing red. The RSI, that's called the relative strength indicator, are at 80 for gold and 83 for silver. These numbers are both numbers which show that gold and silver are seriously overbought or in overbought territory.
What's in overbought mean?
It means that too many people have bought it in a rush, and some of them will change their mind next week and say, oh, maybe I made a mistake and sell what they bought, so the price goes down. But perhaps I should stress that overbought conditions can last for a very long time, and without the price going down, overbought conditions can become, or will become, normalized. But overbought conditions don't say for sure that the price won't continue surging ahead. It can surge ahead for a long time. But the warning is this: when we have a crash in a commodity, in a stock market or anything, it usually comes from a situation when it has been overbought. But overbought doesn't mean to say it's going to crash, but a crash usually does come from overbought. So it's like not a guarantee that it goes down. It could continue surging higher and higher. It's just that if if a crash is coming, people say, "Told you so, it was overbought." So they always say after the event, anyone could see it was coming, it was way too expensive. Having said that, if you're in it for the long term and you're not planning to sell anytime soon, does it really matter whether you pay $100 more or $100 less or $500 more or $500 less? Because I think that at some point you'll be needing that gold and the silver to get you across the line from what's going to happen, which basically will mean that other investments you'll probably, to the extent you own other things, you'll probably suffer quite significantly.
The recent rally across precious and industrial metals is signaling a more profound shift in global capital flows. Platinum surged nearly 4%, palladium rose over 5%, and copper, the so-called metal with a PhD in economics, jumped 6% in a single day, its most decisive move in months. Much of this strength is tied to resurgent Chinese demand, as the country continues to expand its infrastructure footprint through new highways, rail systems, and industrial power grids. Meanwhile, the Western world's AI and data center boom is driving massive copper consumption, feeding into a longer-term supply squeeze. The story behind copper's sudden rise also reminds investors of a timeless truth. Tangible assets remain central to real-world value. Whether it's gold, silver, or industrial metals, scarcity and utility drive their importance in a global economy built on promises and paper. As monetary and trade uncertainty mount, these assets act as both shield and signal, showing where confidence and capital are quietly migrating. Global markets are changing shape, and those who understand the role of hard assets will be ready for the next phase. Let's get back to the interview.
So platinum and palladium were not left out in the precious metals rally yesterday. Yesterday, platinum rose 3.9% to $1,648, and palladium rose 5.2%, that's a lot, to $1,478. But it gets better. Now, this is not a precious metal, but one thing which did rise in the commodity sector was copper. Copper surged 6.02% on the day. It's up 9.3% on the month, which isn't quite as much as other things, and 16.66% year to date. So copper is severely lagging all the other precious metals on the year to date. But yesterday's move, there was a bit of a surge. And why was the surge in copper happening? Well, the answer is simply strong Chinese demand. I can tell you that across China they're building new motorways, they're building new railway lines. The demand for copper is huge coming out of China. And of course we've got in the Western world huge demand coming from all these data centers, which they basically need a lot of copper to get well, you've got a lot of power going into the data centers. It's like powering an entire city, some of these things. So yeah, that takes a lot of copper wiring. So the demand for copper is not about to go down, and maybe copper will be the new gold. We will see, but don't try and buy the physical bars. They are very heavy. And here's a little story for you about something which happened once when I was working. Now this happened, maybe 40 years ago, maybe 35 years ago, when I was working in a wealth manager in Switzerland. And one of my colleagues, I was a team leader at the time, one of my colleagues came to ask me to sign off on a transfer to Indonesia. It was a large transfer, maybe £1 million or something like that. And this was from a client living in the UK. And I said, that seems a bit odd. What's going on? He said, I don't know, we just got instructions. I said, well, you've got to find out. It doesn't feel right. So I rang the client and asked him to explain to me why he would be transferring £1 million to Indonesia. And the way he put it was, my best man, my servant, somebody who I've been friends with all my life, he's been working as my employee all the life, is out in Indonesia, and he's found an opportunity to buy gold bars from a very elderly tin miner guy. He's got a tin mine and he's got all these gold bars he's been storing up for decades, and he doesn't want to sell them, but my friend will take them to the Indonesian central bank, who will buy them from him for the market price. So there's a huge profit in it, but I need to have £1 million sent over there for buying the gold bars. And I said, well, I think this isn't real. It doesn't sound real. Why would anyone sell gold to you for less than the real price? Why doesn't the guy just sell them directly himself? He said, oh, there's some special reasons I can't go into, but this is real. And I said, well, how do you know? And he said, well, I trust this guy all my life. I know him. He's the most honest guy I've ever seen. I said, well, to be honest with you, I don't believe you. I'm not going to stop you sending the money, but really, I'm trying to give you a warning and a couple of days grace to try and think about it and see if you're really serious, because I think you're going to lose 100% of your money if you send it. And he said, no, Clive, I'll send you the evidence. And I said, okay, I'll wait for that. Anyway, he sent me through a photograph of the guy carrying these large size bars. They're about that size, and he had a stack of them, like a little pyramid in his arms. Now, I don't know if you know anything about gold. If this was gold, you wouldn't be able to lift it. That would have weighed several tons. That's right. A ton is 1,000 kilograms. It's like huge. And each of these bars, if it was real, would have weighed. It looked like perhaps 40 kilograms a bar. And he probably had 20 of them, so that'd be 800 kilograms. Nearly a ton. Maybe I didn't add it up, but the fact is it could not have been gold, because otherwise he wouldn't be able to hold it. So I wrote back to this guy. I said, I don't think this is gold, otherwise you wouldn't be able to carry it. Either it's chocolate bars, or it's copper bars. And he wrote back, no, it's definitely gold. Anyway, so he then wrote a letter. I said, look, I don't want you to lose your money because you're going to lose it. And he then wrote a letter of complaint to my management saying, one of your officers refuses to comply with my instructions. It wasn't that I was refusing, I was trying to give him time to think. We can't refuse an instruction to pay clients money, but I was trying to give him time to think, not lose his money. Here he wrote this letter, very rapid letter to the boss, the head of the bank, and the head of the bank said, he's had his warning, you've warned him, send the money. I said, well, I was going to do it anyway. So we sent the money. Well, the money he sent to Indonesia, and this wasn't the only payment. It never came back. He lost it. Well, he believed he was going to get back the money plus a big profit. But yeah, it never came, of course. So what else is going on in the world? We'll finish off very quickly. Interest rates. The markets are currently pricing in a 97% probability of a 25 basis point cut by the Federal Reserve on October 29th. Assuming that cut does come, it will take the interest rates in the United States down to a range of 3.75% to 4%. And the probability of such a cut happening by the year end is now priced in by the market at 100%. There hasn't been much change in US yields, which have been drifting very slightly lower on the back of these interest rate cut expectations, but it's not enough to talk about. It's almost imperceptible. As far as Europe is concerned, the European Central Bank, the ECB, is not expected to cut its interest rates. It has basically said that it believes that its current policy is robust enough to keep a steady hand and to manage shocks. We'll see. Last night, the euro and the Japanese yen fell very, very slightly against the US dollar. No big change. What else? The GDP Now model, which is published by the Atlanta Fed, they're not subject to the government shutdown, which is going on in the United States. The GDP model published by the Atlanta Fed stands at 3.8%. That's a mirror sort of gross domestic product, but if it's correct, it suggests that there's stronger than expected growth in the USA. So what have we got coming up in the coming weeks? Not a great deal. We've got the 29th of October FOMC, Federal Open Market Committee report, where they'll decide to reduce interest rates by 0.25%. We've discussed that. And then the big day, I suppose, will be November the 1st, which is the day on which President Trump's threatened tariffs against China will be brought in unless they negotiated something. It's also the day the export controls on US software, certain software anyway, to certain countries comes into effect as well.
The surge across metals markets is painting a clear picture of global transition. Platinum, palladium, and copper have joined gold and silver in a synchronized rally that reflects profound structural shifts beneath the surface of the economy. From China's massive infrastructure drive to Western demand for copper in AI data centers, the appetite for real commodities is climbing while confidence in fiat assets quietly erodes. These price moves aren't short-term noise. They're signals of a revaluation of tangible wealth in a world drowning in debt and monetary manipulation. In every major cycle of financial history, hard assets rise when trust in paper fades. What we're witnessing today may be the early stages of that same rotation, where gold, silver, and even copper reclaim their roles as the anchors of real value. The lesson is timeless. True wealth isn't printed, it's mined. The metals are speaking, and the world is finally starting to listen. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.